35 Eview cinemas. This is the last question under reconstructions and reorganization part. Yahoo! We have reached finally. So I will first, right? We always start with as you can see from here, 36 to 47 is risk management. So part A, calculate the expected sales price of EV clubs and demonstrate its impact. Okay, the impact of sale on Eview cinemas. Statement of financial position, focused earnings per share, and weighted average cost of capital. So you have to calculate the expected sales price of Eview clubs and the impact on financial position, EPS, weighted average cost of capital, the WACC. You need to show the impact of that. And B, and it's for 17 marks. B, evaluate the decision to sell the EV clubs. Evaluate, this word means advantages and disadvantages. You need to talk about both advantages and disadvantages and then come to a conclusion whether it is better to sell the EV clubs or not. What is this EV club? We'll see. So Eview Cinema Companies is a long-established chain of cinemas in the country of Thailand. 20 years ago, Eview Cinema Company Board decided to convert some of its cinemas into sport gyms known as EV clubs. So now you know what is EV clubs. It is about sports. The number of EV clubs has expanded since then. Eview Cinema Company's board brought in outside managers to run the EV clubs. But over the years, there has been disagreements between clubs manager and the board. The managers have felt that the board has wrongly prioritized investment in and refurbishment of the cinemas at the expense of EV clubs. Right? The management was thinking that the company is investing more in the cinemas compared to EV clubs. So 5 years ago, Eview Cinema Company undertook a major refurbishment of its cinemas, financing this work with various types of debt. How are they doing that? How are they investing in cinema? By taking finance of various types of debt. So, including loan notes at a high coupon rate of 10%. Shortly after the work was undertaken, Taria entered into a recession, which adversely affected the profitability. So, the finance cost burden was high now, and Eview Cinema was not able to pay a dividend for 2 years because they had taken loan. Right? Eview Cinema companies, they have taken a loan to finance the refurbishment of in cinema, and now that the country went into the recession, they have to pay the interest, and interest is high. So because they have to pay the interest, they cannot pay the dividend, right? Because finance cost, interest, we know that is compulsory. You have to pay. There is no doubt. You're obligatory to pay that. But dividend is based on profits. Let's go to the third one. The recession is now over, and Eview Cinema has emerged in a good financial position as 2 of its competitors went into insolvency during recession. So Eview Cinemas board wishes to expand its chain of cinemas and open new multi-screen cinemas in locations which are available because business were closed down during recession. In 2 years' time, right? It looks like this is a very simple case to understand, not like other previously which were very complicated and so much of information. This is a pretty easy case study. So there are times that you get pretty easy case studies that it's easy for you to read and understand it at first. But some you need to work over and over again. So in 2 years' time, Taria is due to host a major sports festival, right? In the country of Taria, there is going to be a major sports festival in 2 years' time. This has encouraged interest in sport and exercise in the country. And as a result, some gym chains are looking to expand and have contracted Eview Cinema Company board to ask if it would be interested in selling the EV Club. Right? EV Club is what? It is about gym. So now they are asking whether Eview Cinema Company would sell this EV Club because they can see there's an opportunity coming in the market. Sports festival is coming. They will need it. So most of the directors regard the cinema as the main business and so are receptive to selling the EV clubs. Right? They know that their main line is in the cinema. So they are more likely to sell the EV club. EV club is not in their main line of business. It is in sports. Now, the finance director has recommended that the sales price of EV club. So now they have to decide on the sales price of EV club be based on predicted free cash flows as follows. So this is a free cash flow. The predicted free cash flow for EV clubs has been given for the 4 years. Number 2, after year 4, free cash flow should be assumed to increase at 5.2% per annum. So, increase at 5.2% after year 4. The discount rate, always, one thing you have to notice, the cash flow you're referring to, whether it's a free cash flow or is it free cash flow to equity, you have to see that. It's very important. Okay, because based on this you will know whether you have to use cost of equity or cost of capital or WACC to discount. But here it is easy for you, here it is given as free cash flow. And also the discount rate. Okay, so the discount rate to be used should be the current WACC, which is 12%. So current WACC, remember you have to show the impact of the sale on the WACC. So current WACC is 12%. That means you have to see whether your WACC is increasing more than 12% or is it decreasing less than 12%. Now, fourth point. The finance director believes that the result of the free cash flow valuation will represent a fair value of EV's club business, but Eview cinema company is looking to obtain a 25% premium on the fair value as the expected sales price. So now they are saying that the expected sales price will be 25% on the fair value, right? Now, other information supplied by the finance director. So this is some other information. Number 1, the predicted after-tax profits of EV clubs are 445 in year 1. This can be assumed to be 40% of the total after-tax profits of EV Cinemas Club. Okay. What you need to understand is they are giving the EV club's profit. After-tax profits of EV club is 444 in year 1. And this can be assumed to be 40% of the total after-tax profits of EV Cinema. So 40%. Do we know this? After-tax profits of EV Cinema clubs. It's a question mark. We don't know. We have to find out. We have to find that profit. 40% of EV Cinemas club. Right? That means 40% of something is equal to 454. So this they have calculated based on 40% of after-tax profits of EV Cinemas clubs. Do we know the EV Cinemas clubs profit? We don't know. We only know the EV clubs. We need to find for EV Cinema. Okay. When we'll be doing it, solving questions, that time we'll do this. But just you have to make a note of it. So this little things you always have to make note, where you have to find figures, where the figures are missing, right? It will help you at the end. So number 2, the expected proceeds which Eview Cinema Company receives from selling the EV clubs will be used firstly. So the expected proceeds, that means after selling that Eview Cinema Club, after selling the EV club, you will be getting some proceed, right? That's selling. So that proceed, how they are going to use it? It will be first used to pay off the 10% loan note. That means first you are paying off your liability, right? 10% loan note, paying from the proceed of EV club. Part of the remaining amount, okay, after you deduct the 10% loan notes from the proceed, you still have some proceed left. Now how are you going to use it? Part of the remaining amount from the sale process will be then used to enhance liquidity. How? By being held as part of the current assets, so that the current ratio increases to 1.5. What is current ratio? What is current ratio? Current ratio is equal to okay, current assets over current liabilities. So they are saying your current assets over current liability has to be equal to 1.5. They're already giving you the current ratio. It has to be 1.5. So until it becomes 1.5, you have to increase your current assets. How much you have to increase your current assets? So basically it will be your current assets, you don't know, it's a question mark. Okay, let's put Y for current assets. divide by current liability. Current liability you can take from your balance sheet, right? So current liability you take from your balance sheet, multiply by 1.5, you will get how much current assets you have to increase. And the rest of the remaining, after that also you have some amount left. So the rest of the remaining amount will be invested in property, plant and equipment. In non-current assets you will invest, right? Then we have the current net. So the current net book value of the non-current assets of the EV clubs to be sold can be assumed to be 3790 million. Okay. Now, the profit of the sale of the EV club should be taken directly to reserve. So you are going to get some profit from that sale. Now, point 3. Now, Eview cinema company asset beta for the cinemas to be assumed to be 0.94. It is cinema, I am underlining, asset beta 0.952. Make sure that whenever this asset beta equity beta comes, even though this is a reconstruction question, you are selling off, what is the impact? It's a reconstruction, but still you have to calculate WACC, still you have to calculate cost of equity, still you have to calculate asset beta, still you have to calculate equity beta. These things you need to calculate. This comes from your which syllabus, which part of your syllabus? Investment appraisal, asset beta, re-gearing, gearing, re-gearing, ungear, all these topics, they are coming from section B, investment appraisal chapter. So if you are not good in that investment appraisal, you will be not scoring much in reconstruction. Remember, every syllabus is linked to every syllabus. When you study also, don't study a syllabus in isolation. One area is connected with another area in your syllabus. That's how it is formed. So if you are not able to calculate this, if you are not good in regearing, you will not be able to calculate equity beta. If you cannot calculate equity beta, you cannot get cost of equity. If you cannot get cost of equity, you cannot calculate WACC. If you cannot calculate WACC, you cannot discount. See how many processes it is linked. So you are going to lose marks in every stage. And finally your conclusion which you are going to give, the impact, whether WACC is increasing or decreasing, you will not be able to give. That's why this question I kept it till the end, because I want to touch this area. This area includes all the part of your syllabus. Next, point 4. Eview cinema has, so now you are given the equity and the debt portion, because you need to find the market value of equity and debt for you to find WACC. So Eview cinema currently has 1,000 million $1 shares in issue. They are currently trading at 15.75 per share. The finance director expects that the share price to rise by 10% once the sale has been completed, as he thinks that the stock market will perceive it to be a good deal. Through this, what can you get? Market value of equity. See, this is how I annotate. Rise by 10%. Next, fifth one, right? This is my asset beta. This is how you annotate, so that when you come there, you exactly know which point to take. Asset beta of cinema. Next, tradable debt is currently quoted at 96 per 100 for the 10% loan notes. 96 per 100 for 10% loan notes and 93 per 100 for other loan notes. You have to be very, very, very careful in point 5. Point 5 is the area where most of you went wrong, didn't perform well. I will tell you why is that. Okay, the trick. How examiners put values and confuse you. Right? You tend to take all the values, or you don't tend to take any of the values. So you have to be very critical what values you are taking for the market value of debt. Your understanding of theory comes in this type of questions where it is not clear. Right? Everything will not be put in front of you. The total market value of debt is this. These are the values you have to take. You have to decide what you have to take for the debt. So the value of the other loan notes is not expected to change once the sale has been completed. That means other loan notes you are not paying off. Even after the sale, it will be there. The overall pre-tax cost of debt is currently 9% and can be assumed to fall to 8% when the 10% loan notes are redeemed. Can you understand this last line? See, currently it is 9%, but it will fall to 8% if 10% loan notes are redeemed. That means it is paid off. And we have been told in the beginning that 10% loan notes will be paid from the proceed of the sale of EV clubs. So that means it will fall to 8%. This is the pre-tax cost of debt. Most of you have taken 9%. Confused. 8%, 9%, 8%, 9%. Right? So it is 8%. And it is pre-tax. Read the word again, pre-tax. You have to adjust for tax. You always have to find post-tax cost of debt to find WACC. Why are we doing all this? Simply to find our WACC only. All this 0.3, 0.4, 0.5, 0.6, all these are needed for WACC. Even 0.8. You have to know which information you need to use for your calculation. You need to know which are the points I need exactly. So this is market value of debt, this paragraph. Next, current rate of tax is 20%. Seventh, additional investment in current assets, right? Are you making additional investment in current assets? Of course you are making. Where are you making that additional investment in current assets? Because you have to increase, you have to maintain your liquidity position. Remember, your current ratio has to increase to 1.5. That's why you have to make investment in current assets. So for that investment, expected to earn a 7% pre-tax return. Pre-tax, even this needs to be adjusted for tax. Right? It is for investment in current assets and additional investment in property, plant, and equipment. We have been told that the proceeds, right? The proceeds from the sale of EV clubs are being used to invest additional investment in property, plant, and equipment, and that return is 12%. So for property, plant, and equipment, it is 12%. This is also pre-tax, adjust for tax. Most of you take pre-tax only and forget to adjust for tax, and most of you are okay. You just assume that post-tax has been given to you. You again go and adjust it for tax. Some of you do this mistake also. Already it is adjusted for tax, post-tax. Again you go and deduct tax from that. So these are the areas you need to work on. Right? Just see. When you are making mistake, also learn from your mistake. What are the common mistakes you do? Where do you always go wrong? What are the things you never understand? Right? So try to improve on those. There is nothing bad in making mistakes. See, I always tell you, mistakes is the you should be friend with your mistakes. Okay, you should make it your friend, not enemy. You should not run away from your mistake. You cannot avoid it. It will happen. Even on the day of exam, after being prepared so much, you will make mistakes. It happens. But the good thing is we always have something we have to learn. We don't have to make it. We cannot let our mistakes decide that whether we'll pass or fail. We have to keep working on it. You get better and better and better. The more mistakes you do, the better and better you get. Right? And finally, the eighth point, the current risk-free rate, and of course, this is given for your CAPM, capital asset pricing model, unit cost of equity. So current risk-free rate is 4%, and the return on the market portfolio is 10%. Okay. Oh God, again this issue. I don't know why I'm not able to use this stupid pen. Sorry, guys. Okay. And market folio is 10%. Don't. Okay. So most of you do this mistake also. you take your beta into the market portfolio, which is 10%. That's wrong. It is not into market portfolio, not into market return. It is market premium. You multiply your beta by market premium. What is market premium? 10% minus 6%. That is your market return risk-free rate. Okay. Now you have been given the financial position of Eview Cinema. So the CEO wants to know what is the impact on the sale of the Eview Club on the statement of financial position. Okay, on the focused at EPS and the weighted average cost of capital. So these are the figures you exactly have to write it, the original figures. Now, A, calculate expected sales price. So first we are going to work on the expected sales price. For that, what do we need? I have told you in question 34, right? If you haven't checked, by the way, please go and check 34. Okay, the sales price, the starting point what you know is how do you calculate the sale price, right? See, showing the impact on financial position, EPS and WACC, you know. But sale price, how will you start this? You have been given information here. This you have to start. So your first point is here, free cash flow. Because they told free cash flow plus a 25% premium. That will be your sales price. So you start from your free cash flow. This is your starting point. Let's see. Let's work out. Marking scheme I will show you later. So first let's go through here. Okay, so the process from the sales. So free cash flow, you take all the figures of free cash flow for the 4 years. Discount factor is 12%, right? The current WACC. Discount it, find the present value, and this is the present value 1318. Okay, and we have been told that present value after year 5 will increase by what? 5.2%. So increase 490. Okay, 490 is this free cash flow by 1.52%. Okay, that's why it is 490 into 1.052 divide by 0.12, that is cost of capital minus the growth into this discount factor. It is the 4th year's discount factor. Whenever you are doing for present value in year 5 onwards, the last discount factor, the last years you have to get to multiply. Okay, and the total present value will be your this present value plus your this present value. Present value till year 4 and from year 5 onwards, add both, that is your total present value. On this you have to take a 25% premium. So multiply by 1.25 and this is the sale proceed. Right? So you have calculated your sale proceed. Now let's go to the impact. See how they are giving a subheading. Always put subheading like this for different. There are different requirements. Even there's one requirement. In that one requirement, you have to show 4 requirements. First is proceed from sale of EV clubs. That is short. Now next is impact on the statement of financial position. For that you need the financial position figures. Okay. So and what is the profit? You need to find the profit also. What is the profit on sale? Because your return earnings, right? On the balance sheet you write return earnings after your share capital. So for that you need profit on sale. What is the profit on sale? Because they told clearly that profit on sale is transferred to reserves. Reserves are written in balance sheet. So profit on sale, what is the sale proceeds? 7674. Okay, and this 3790. What is the 3790? It is this 3790. This one. Right? It can be sold. Right? So the net book value of non-current asset to be sold is 3790. And the profit, you have calculated the profit. Now before going to this part and this part, I will take you to the balance sheet. First, for this original, copy paste all the figures from your balance sheet. This is how you have to show the impact. Whenever a question is given impact, original figure has to be there first. Write all the description, right? Non-current assets, current assets, write all your description, then the original. Then comes the second column. This is first column. This is your second column where adjustments will be there. Third is final. So always have a second column for your adjustments so that we know you added or deducted or have done what. Don't directly jump from original to final. Because this is just for 1 year. But if it's for many years, that time you don't have to show adjustments. That time you can just go from original to final. We did a question also, like where for 3 years we had to show the impact on the statement of financial position. For there, you don't have to show the adjustments, but this is just for 1 year, so it will not take so much of time for you to show the adjustments. So first, let's go to non-current assets. Will it change? It will change. It will increase. It will reduce. We'll see how. Okay, that reduction will work out later. Okay, first, current assets, it will increase. We have been told to maintain the current ratio of 1.4. Current assets needs to be increased. How much it will increase? Let's see. So we have told that current liabilities into current ratio, you will get the current assets. Why is like that? Because your current ratio is equal to CA over CL, and 1.5 is equals to CA over CL. So your current 1.5 into your CL will be your current asset. So that's why 1.5 into your current liability. So it is 1.5, and this current liability you have got from your balance sheet 2166. Right? Let's go to the balance sheet. It is this amount. This amount 2166. Okay, they have, so multiply this. This is your current assets. What was your previous current asset? If you see in your balance sheet, it was 2347. So what is that increase? How much it increased? By 902. That's why they have shown here 902 it increased. And the final. Next. Okay. So now we can go and work on your non-current assets part. Why I told you to work on non-current asset later? Because first we have been told that with that sell proceed, what they will do? They will pay the debt, 10% loan note. They will increase current assets. Then at the end, they will invest in the non-current asset. That's why that should be the last item to find. So now we can find the non-current asset part. Go to this paragraph. Increase in non-current asset. Okay, we'll see how much. Increase in non-current asset is equal to proceed from the sale less. Okay, so how much non-current, how much money you will have to invest in non-current asset from the proceed of sale of EV. This was the proceed. You can go up and check less 902, because you will always, you will not minus the final figure. Okay, final figure of current assets. No, how much it increased, only that increasing part or decreasing part. So out of that 902 you invested in current assets, so you have to minus that from the proceed, right? Because increase in working capital, you can say increase in working capital also, because anything you invest in current asset, if your current asset goes up means your working capital is going up. Less 3200. What is this 3200? This is a loan note repayment. They told they will first pay that. What is this loan note repayment? How much it is? If you go to the balance sheet, you have been given three things: 10% loan notes, bank loans, other loan notes. Only this 3200 will be paid. So that 3200 is being paid from here, minus from that, and you are left with this 3572, right? 3572. So that means how much can you invest? Only up to the whole amount 3572. Why you cannot invest more than that? Because see, this is then reduced by the sale of EV clubs with non-current asset given at 3790. So this is the amount which you are going to sell the non-current asset. The amount of the non-current asset which you are going to sell is 3790, and you have 3572. So your non-current asset is going down by 218. That's why it is in bracket here in adjustment. So it is decreasing. Right, now let's go to your share capital. Share capital, called up share capital will be 1000 only. There will be no change in that. Retained earnings will change. How your retained earnings changes? How this 3884? It is just this profit. I've told you, this is the reason you need to calculate profit. See, every calculation you calculate, always know in back of your head why you are calculating, how you can use it later. First that you have to know. If you decide that, then you can accordingly calculate and keep it ready. Even at that moment you don't calculate profit on sale, it's still okay. When you come here in the retained earnings part, that time also you can calculate profit on sale, there's no harm. But by the time you come there, you might have forget what you need. Maybe you might keep the same retained earnings. It's better whatever you remember. Whenever you remember something to calculate, it is better to calculate it and keep it ready rather than keeping it for later. Because later you might be so pressurized, you might forget. You will be tensed. Time is running away. You might be stuck somewhere. It is not that you will be able to solve the paper very smoothly in every part. No, never happens. You will be stuck somewhere. You will be wasting more time over there. So you will forget to do the easy calculations. Always keep easy calculations. Whatever you think you can remember and you need, keep it ready somewhere. Maybe you don't need it now, but later you might need in some parts like this retained earnings. So that profit on sale now you need. Next, let's go to the non-current liabilities. Your non-current liabilities, see 3,200, it is paid off. So you will not be left with anything. Okay. Other loan notes, it was 2,700, still 700. Bank loans, still same. So rest all is same. Now let's go to the impact on EPS. Okay. When you go to the impact on EPS, earnings per share, that means earnings you need. Earnings means you need profit after tax. That is a starting point. Profit after tax you need, right? And profit after tax, how you will get this 1135? I have told you before somewhere. I have put a question mark, I remember. See, this is what happens when you note something, you remember that somewhere you have noted something. So now quickly I can go and turn there. I don't have to read all this blah 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 paragraph. I don't have to read. Exactly, I went to the location. It is point number 1. The predicted after-tax profits of EV is 454. You have been given the after-tax profits of EV clubs, but we want for the EV cinema. So EV cinema, they told 40% of EV cinema is EV clubs, right? That means 40%. Let's say 40 sorry. Okay, I will directly show here. It is easier. Damn, again this pen is not working. Okay, so 40% of something, okay, we'll keep it as y is equal to 454. This is what it means. It is not 40% of 454. Okay, it is 40% of something is equal to 454. Let's take it as y. Okay, we'll keep our variable as y. I'm using algebra here. You can use any letter, okay? So 40% of y. That means 40 over 100, okay, multiply by y is equal to 454. So we need to find this y. What is this y? So to find y, it will be, okay, 454 multiply by 100 divide by 40. You will get y. Okay, 10 into 4 or 100 divided by 40 is the same thing only. It is the same thing. Okay, because most of you might be confused why it is 10 over 4, how they got this 10 over 4. You are running to get that 10 over 4 figure. See, if you are very strong in your principle, you know exactly how to calculate. Numbers doesn't matter, right? Most of the time, if you see, they use very simplified version. They don't show you the whole amount, how they calculate it and all. This is the reason why a tutor is needed. Everything cannot be learned by just, by yourself. There are areas which you need like this. So you get 1135 because you have to show the impact on the EV cinema. So that's why you need their profit, EV cinema's profit. What will you do with the EV club's profit, right? And it will be same only. Post-tax profit already adjusted for tax. Post-tax already adjusted for tax. Don't go and deduct tax from there. Less profit from EV clubs. Okay, that EV clubs profit has been given to you 454. Deduct it from here. It will be deducted. Why? Why it will be deducted? Because you are selling EV club. If you are selling EV club, will you get the profit of EV club? Whatever profit EV clubs get, you will not get. You have to deduct it. Most of you, till here, it is okay for you. You think that's it. That is the profit. That is the mistake you do. Most of you forget about this thing. Add. interest save. Okay, these are the three areas. We are saving interest now. We have to add interest save. Whenever interest save, we need to add. When interest, we have to pay additional interest, we have to pay. Why interest is saving and how is saving? How it is saved? Because you are paying the 10% bank loan note. So if you are paying that 10% bank loan note, that interest you are saving, you don't have to pay interest anymore. The loan you have paid off. So for that interest is saved, that interest saved, you need to calculate that also net of tax. Everything is net of tax. What was the tax? Tax was 20%. That's why it is 1 minus 0.2. Interest was 10%. It is 10% bank loan and it was 3,200, the value. And it is tax saved. Next, return on additional non-current assets. Right? On the additional non-current assets, the rate is 12%. That was pre-tax. So adjust it for after tax 1 minus 0.2. It is on 3572, this value. We'll check 3572. It is this 3572, right? Basically, we are deducting this, okay? We are deducting this 3790 by 352 to get this net change. It is not on this net change. It is this 3572. This is your additional investment in non-current asset. So on this 3572, you are paying 12% tax. And then comes additional non-current asset. Sorry, additional current asset. Current asset is how much? 902. On this 7%, because for current it is 702. Add all, get your profit. Number of share was 1000 divided by number of share. This is adjusted EPS. Fine for before also. Before it was 1.135. You saw how it increased? EPS increased. That means it's a good. Now, finally, impact on WACC. Impact on WACC. Okay, so now, see, impact on WACC. Whenever WACC question is there, this question has been asked from many to me. Sabi, how do we know when WACC question is there how to start? Because we are confused. There are so many things: equity beta, asset beta, this beta, that beta. So many betas are given. Where to start from? Okay. So the process is this. These are the few steps. If you follow, you can never go wrong in WACC. First, again, okay. First is asset beta. Asset beta is number one, and this will be given to you. If this is not given, at least equity beta will be given to you. So if equity beta is given, using equity beta, you can find cost of equity. It's more easier. One step is less. But mostly asset beta only they will give you. Asset beta will be given to you. So based on this asset beta, second, calculate equity beta. From asset, always equity beta comes. Number three, once you find the equity beta, use equity beta to find cost of equity. How do you get cost of equity? CAPM. Fourth, WACC. You know cost of equity, you know market value of equity, you know cost of debt, you know market value of debt. Right? Your market value of equity and market value of debt and cost of debt has to be ready, by the way, before you go jump to WACC. Keep it ready, do those working also. Maybe before you can keep it ready, or at this time when you are finding WACC also, you can calculate it, whatever it is. So here they have started working on the market value of equity and debt first. Okay. So the calculation is to find equity beta. So first, market value of equity, VE. So market value of equity is this. They have been given here that it is See, because I have annotated market value of equity for zero point 0.4, now I know that I have to refer zero point 0.4 only. It is 1000 into 15.75 into 1.1 because share price will rise by 10%. So that's why this is my equity now. Market value of equity 15750 into 1.1. Market value of debt. I'm underlining this because most of the good thing is market value of equity. Most of the candidate in any question, even in appraisal question also, easily you can calculate. Problem comes in the market value of debt because there may be many types of debt. Cost of debt might be different, and debt you need to adjust also. It's not that it's very easily given to you. Sometimes you need to calculate. I think in question 34 we did like that, something like that. For 4 years we had to calculate debt and all those things. Okay, market value of debt. Now there are three debts given to you. Three debts in your balance sheet. Go to your balance sheet. Okay, I will go to the new balance sheet. You have to use the latest balance sheet, the final balance sheet. Go here. Some of you have included this also. Is it needed? Can you put that 3200? Yes, you have been given the cost of debt for this also, this 10% also. But can you use it in your WACC for your market value of debt? Whatever market value of debt you put only will go for WACC. So can you use it? Think practically. You cannot use it. You have paid that 3200. They have told if it's redeemed, cost of debt will reduce to 9 to 8%. So this, there is no use of putting this here. If you are putting this, then you are not prepared well for this. You are already putting two other loan notes, bank loan, only this two. That also this value will go. So this and this. For 985 only you will take. Only for your 2700 other loan notes you are given cost of debt. You need to adjust it for tax. That's what they have done here. Adjust for tax and all later. Okay. But 2700 into 0.93 plus 985. Why multiply by 0.93? Check here. Point number 5. Tradable debt is currently quoted at 96 per 100 for 10% loan notes. Most of you go and take that 10% loan and you start at multiply by 0.96. Don't do this. This is why I've told you, just because an information is given, don't be in so hurry to use that information. Everything is not needed. Okay. You have to be very alert, very careful of what figures you're using. And 93 per 100 for other loan notes. So it is 93 per 100. That means 93 divided by 100. That's why it is multiplied by 0.93. The way, okay, this is the way. Most of the time, this is the way your debt price will be given to you. In all the questions I have seen this. Per 100, 93 per 100, 92 per 100. So it is multiplied by 0.93 for bank loan 985 only, because we have not given any market price. Okay, so you have been given the total. Now BE, see, you don't have to use asset beta, equity beta. If you don't want to write it in full, it's okay, you can use this symbol. The symbol is understood. If it's B, beta E, cost of equity beta. If it's beta A, asset beta, it is understood. And this formula is also there. Okay, the formula, from the formula only they are doing this. This formula is there in your formula sheet, you will get it. How to find equity beta when asset beta is given, right? So it is, the formula is your asset beta multiply by, okay, value of equity plus value of debt divided by value of equity. This is the formula, exactly that formula is given. And the formula for equity beta is value of equity over value of equity plus value of debt multiply by sorry, this is the formula for equity beta, I'm sorry. But when it comes to asset beta, okay, It is the other way around. Okay, we'll not talk about the other one, otherwise we'll get confused. Okay, so equity beta, this is equity beta. Okay, this is your asset beta. This multiply by value of equity, this one value of debt plus value of debt, and it has been adjusted for tax also. 1 minus 0.2, tax was 20%, and divide by your equity value, right? This formula, and you will get your equity beta. This is your equity beta, and always check whether your equity beta is greater than your asset beta or not. Okay, this has to be always, asset equity beta should always be more than asset beta. So your asset beta is 0.952, which is more than, less than equity beta. So you are correct. Technically you are correct. If you are doing some arithmetical errors or calculation, that's your mistake, that's your fault, but technically this is right. Okay, so revised cost of equity. Now use CAPM. Whatever you're doing, always use subheading what you are calculating. If it's cost of equity, write cost of equity. If it's WACC, write WACC. Okay, write revised, write this word revised WACC, so that you know that this is the new one. Now you can compare with the original. So cost of equity, so this you have been given, this cost of equity, sorry, equity beta multiply by market return is 10, risk free is 4. So don't multiply by market return, don't multiply by 10%. It is 10 minus 4 plus 4%. So 10.64% is the cost of equity. Use this cost of equity in the WACC. Next is WACC. So 10.64 value of equity over value of equity plus debt. This portion you understood? Because we have paid off the debt, 10% loan note. So cost of debt will fall to 8%, from 9 to 8. Okay, and it will be adjusted for tax. That's why it's 1 minus 0.2. Then value of debt over the total value. So 9.93. Can you see that WACC reduced or not? WACC reduced. Why? Go up. Check here. WACC was 12%. Now WACC is what? 9.93%. So that's a good thing. WACC reduced. Even EPS increased. So it seems like that selling EV is good. But hold down. Hold down. Go to part B. Part A is over. Evaluate the decision to sell EV clubs. Whenever this question comes, evaluate to take a decision whether this decision should be. You should not always give financial information. You should not always talk from the financial perspective that EPS increased, this increased, that's why you go for sell. You also have to talk about other non-financial factors. This is the mistake, because we are so much indulged with numbers. We always think about numbers. But you need to talk about non-financial factors, the qualitative factors as well. Both finance and non-finance factor needs to be talked together, and then you need to say whether it's better or not. So let's see how this answer is framed, and with this will end our part D, syllabus D, reconstruction and reorganizations. Okay, so shareholders would appear to have grounds for questioning the sale of EV clubs. Of course they will have question. If you sell something, you need to question that why you are selling. As a shareholder in your business, if you are selling something, you need to question that. Why is the sale happening? What is the motive behind the sale? So it would mean that Eview cinema was no longer diversified into two sectors, right? If you sell, don't think that because you're getting financial, there are disadvantages also of selling. You are no longer diversified now. Earlier, when there's a risk in your cinema, you can still survive on the profits from the club, Eview club, but now you are only dependent on Eview cinema. So you're no longer diversified. That is one disadvantage. Although shareholders can achieve diversification themselves in theory, in practice, transaction cost and other issues may mean that they do not want to adjust their portfolio. Right? Because of this transaction cost and other issues, the shareholders might not want to sell the club. Next. See, always keep one line. It is always in paragraph. You will never see a question in AFM answer where it is not without paragraph. Everything is in one. It's not an essay writing or something. or not in a story writing. Your writing has to be very professional. The tone you use, it has to be very simple in nature. Use very simple language. This is not English language exam or something, so don't try to use complex words which you yourself don't understand. Okay, don't use sophisticated word. Use very simple, easy to understand. Keep it simple, short, and easy to read. And also in paragraphs, so that we know that you are talking from one point to the next point you are going. Now here they are talking about second, increase in gym membership brought about by the forthcoming sports festival could justify the predicted increase in free cash flows made in the forecast. Did it increase? Wait and see. We'll see. Go to the free cash flow. Yes, just see the present value. Right? Or just check the free cash flow. I'm sorry, the free cash flow 390, 419, 455, 490. It is increasing. Free cash flows keep on increasing. So they are saying it is justifiable because there's a sports also coming up, right? Sports festival. So although increased earnings per share, we saw that EPS increased. Okay, are focused once the EV clubs are sold. This are dependent on EV Renema companies achieving the sales price which it desires for the EV clubs. It also depends on the sales price which they desire for the EV clubs. Sale price, what we have taken the premium 25%. Okay, and the predicted returns being achieved on the remaining assets. Next, the proposed expansion of multi-screen cinemas may be a worthwhile opportunity. Right? So they're talking about one point in one paragraph only. They have elaborated it so much, that's why it's 4-5 lines. So they're saying that expansion of multi-screen is a worthwhile opportunity, but the level of demand for big cinema complexes may be doubtful. And there may also be practical problems like negotiating change of use. It's hard to change from cinema to sports. So there'll be a problem. And you always have to use some figures you have to use in your theory part also. So in year one, the EV clubs would be focused to make a post-tax return of assets of this. 454 was the profit after tax. 3790. What is this 3790? EV club would be sell for 3790. Right? So 454 divided by 3790. The amount of assets, the net book value of assets which will be sold was 3790. So 454 divided by 3790, it was 12%. Compared with 12% into 0.9 on the additional investment in assets. If you are investing additionally in cinema, non-current asset, it was 12%. Multiply by 0.8 because after tax. You're taking it after tax. 20%. So it was 9.6%. That means post-tax return on assets from EV club is more than investing more in cinema. Investors may also wonder about the motives of EV cinema company's board. Right? As I told you, you need to know the motives. Selling the EV club offers the board a convenient way of resolving the conflict with the management team of EV clubs, and investors may feel that the board is trying to make an easy path by focusing on what they are comfortable with managing. So they might think that okay, they are selling because they don't want, it is not their main line of business. They are very comfortable with cinemas, so it's easier for them to work in their main line of business. Sports is not their main line. It is not their, they're not expertise at that. So it is better to sell them off so that they can only focus on one area. Right? Next, there may be arguments in favor of the sale. However, the lower WACC, whatever calculation you have done, you need to bring here. Okay. So the lower WACC will be brought about by a fall in the cost of equity as well as the fall in cost of the debt. We saw the debt fell from 9 to 8%. Okay. And it could be cost of equity. We don't know. So a reduction in the complexity of the business may result in a reduction in the central management cost. So if you are selling it off, they are saying even your central management cost will fall down because it is becoming more simpler now. Next, the last paragraph. Eview cinema may also be selling at a time when the EV club chain is at its most attractive as a business in the period before the sports festival, because they know if they sell before the sports, there are so many people waiting to take it, because they need, other business might need it before the sports festival. So before the sports festival, if you're keeping it as a sell, that is the time when your business is most attractive and you can get the most out of it, and you can get even the premium also. So the premium directors are hoping to obtain on top of a valuation based on free cash flow figures, which may be optimistic. So this must be optimistic also, okay? Suggests that they may be trying to realize maximum value while they can. Okay, so that's it. And let me take it to the marking scheme is very important. Why? The mistakes I want to show you. What are the mistakes? Possible mistakes which have been attempted in this question and which I advise you not to do. Okay, so valuation is here and also reorganization. Part A, easy marks. Part A offers easy marks for determining the sale process. So to get that sale process is easy. You just draw the free cash flow, increase it, and take 25%. Add 25% premium. Okay, in part B, there were marks available that did not relate to the calculations in part A. You have to relate. One part is related to the other. Okay, but instead were based on non-financial strategic factors relating to scenario. Examining team comments. Okay, in part A, majority of candidates omitted to add back interest saved from paying off the loan when calculating adjusted earnings per share. This is one mistake. A large number of candidates either included the loan already repaid or ignored the bank loans in determining the company's WACC. So you included the loan which has been already repaid, the 3,200. That was one mistake. Or ignored bank loans at all from the WACC. You didn't put that bank loan because you haven't given the market value. You were not given the market value. Remember in point 5? So you ignored. Quite a few candidates made a basic error in using market return instead of market premium. When calculating company's cost of equity, you have to use market premium, not market return. Sometimes you are given market premium, sometimes you are given market return. Check what you are given. If it's market return, minus risk free. If it's market premium, take it as it is. Part B required an evaluation of the decision to sell off the unbundled part of company. Most decisions were too narrowly focused on the results from the calculation produced in part A. You already discussed what happened. WACC reduced, EPS increased, that's it. You need to talk about other financial, non-financial factors as well. That's the reason why I've taken you through question B also. Now we'll go to the marking scheme, how the 17th mark has been given to you. Free cash flow, year 1 to 4, 1 mark. You see, you cannot go wrong here. Everything you need to be correct to get that 1 mark. So free cash flow from year 1 to 4. Okay, from year 5 onwards, 2 marks. Sale proceed, 1 mark. Impact on the statement of financial position, 4 marks. EPS, 5 marks. Okay, so sorry, impact of EPS and impact on WACC together makes 5 marks. Next, equity beta for cinemas. Okay, and revised cost of equity and then revised WACC, 2, 1, 1. Okay, your equity beta is for 2 marks. You need to do calculations there. You have to find market value of equity, market value of debt. That's why it's more marks. Next, part B. Arguments against sell, arguments for the sell. You need to evaluate. Evaluate means pros and cons. So that's it for this question. With this, I'm happy to announce that I have finished the syllabus of reconstructions and reorganizations. I have uploaded all the videos on the topic area of reconstruction and reorganization, and also I have finished all the questions relating to that section. And don't forget to subscribe to my channel if you haven't subscribed. Thank you and take care.